Welcome to Alamut Capital Knowledge Center for yet another knowledgeable session. Most people, when they think about investing, think about one thing: picking stocks. It's the first question I hear in almost every conversation. Which stocks do you like right now? It feels natural, right? You buy good companies, hold them long enough, and wealth builds over time. But what if I told you that stock picking isn't actually designed for individual investors? In fact, it's a professional pursuit, and it often works against the goals that really matter to you. Let's talk about why. Stock picking has become the face of investing because it's simple to understand. You analyze a company, look at its products, management, and valuation, and if it looks promising, you buy it. That's the way mutual fund managers, hedge fund managers, and research analysts operate. Their job is to identify potential outperformers, to beat the market, because that's their performance metric. But here's the key difference. They don't have personal financial goals tied to those portfolios. They don't have to send their kids to college using that portfolio. They don't retire from it. For them, stock picking is a profession. For individual investors, investing is about achieving life goals. And that's a completely different game. Stock picking is like Formula One racing. In Formula One, drivers push cars to their absolute limits. Every corner, every overtake is about maximum speed and performance. Crashes are part of the sport. It's expected. Now, imagine taking that same approach on your daily commute. Would you drive to work like a Formula One driver? Of course not. Your goal is to arrive safely and reliably, not shave seconds off your time. That's the difference between a professional stock picker and a personal investor. One is racing for performance. The other should be driving for consistency and safety. Stock picking is about beating the market, not aligning with personal goals, timelines, and risk comfort. For most people, that mismatch can quietly work against real wealth building instead of supporting it. The problem with stock picking isn't that it's wrong. It's that it fails to consider the bigger picture. When you focus on individual companies, their stories, their products, their valuations, you often ignore how those pieces fit together as a portfolio. That means you can end up with hidden concentration, overlapping risks, or portfolios that move exactly like the market, but with more volatility. And when markets fall, that concentrated risk can derail your goals, because you were never managing risk at the portfolio level. Even statistically, stock picking is a tough game. A landmark study by Hendrik Bessembinder found that only 4% of US stocks have created all the wealth generated in the market since 1926. The other 96% either matched treasury bills or lost money. That means unless you happen to own those few top performers and hold them long enough, you're likely to underperform the market. And that's not just theory. Over 85% of stock-picking mutual funds underperform their benchmarks over 10 to 15 years. So if the professionals with full-time research teams struggle to beat the market, what are the odds for a regular investor picking a few names on their phone? So what's the alternative? Instead of trying to pick the next great stock, focus on building a portfolio strategy that's designed to help you reach your goals, safely, consistently, and intelligently. That means thinking about market beta exposure, by capturing the overall market return efficiently. Factor investing, by tilting towards proven, systematic drivers of return, like momentum, value, quality, and low volatility. Risk-managed diversification, by combining different assets and strategies so your portfolio can adapt across market and macro regimes. This is where quantitative and systematic investing shines. It doesn't rely on gut feelings or stories. It follows data, discipline, and adaptability. Systematic strategies integrate risk management right from the start. They size positions carefully, they adjust exposures when markets shift, they manage volatility, so the portfolio is resilient, not reactive. That's how you get steady compounding, not from finding the next Tesla, but from staying invested through every market cycle with controlled risk. And that's the real secret to building long-term wealth. For most investors, it's time to move beyond stock picking. Instead of asking, which stocks should I buy? Ask, what strategy will best align with my goals and risk profile? Because the truth is, your investment success isn't about beating the market. It's about reaching your financial goals with consistency, discipline, and confidence. That's what real investing is about. Stock picking will always have its place. It's a fascinating profession like Formula One, but for most investors, it's not the right approach. Your journey isn't about racing or performing, it's about arriving safely and growing steadily along the way. Invest in strategies, not stories. Focus on process, not predictions. And remember, wealth is built not by chasing the next winner, but by compounding intelligently over time. That's the difference between investing like a professional and investing like an individual should. Thanks for watching the video. Please reach out to us at alamut.capital to get you free consultation today.